Hey guys, in this video, I want to talk about all the financial milestones that we should aim to achieve while we're in our 20s. I'm 23, and in my time in college, I realized that no one really bears the responsibility of teaching the young adults the adverse world of personal finance and money management. The education system just doesn't seem to cover these things from my experience. I've been doing my own personal finance research for years at this point. These are some goals that I've set for myself, as well as some that I've already accomplished. This video is meant to be an all-in-one in understanding a solid foundation in managing your money. I hope this video provides value for you, and if it does, go ahead and leave a like and share it to someone that you want to see succeed with their money as well. Okay, the first milestone that I think you need to accomplish in your 20s is taking care of your debt. You need to make a plan to pay off your debts. A real plan. I want to start by talking specifically about student loan debt. In 2024, the average student loan interest rates were somewhere between 6 and 8%. From my experience, that was pretty shocking because I grew up under the impression that student loans would be somewhere around 4 to 6% interest. So seeing that current student loan rates are comparable in interest rate compared to my current auto loan of around 7.5%, I was quite surprised. As far as what to do about that debt, typically, people might want to invest in the stock market rather than pay off their student loan debt because the spread on investing could net you an average of around 2 to 3%. But with current interest rates, even if you were to make 8% in the market, that still can just break you even on 8% that you would be getting in your loan. And because you're inherently taking on risk, putting that money in the market, rather than just paying it directly off into your loan, you're almost guaranteed a better return on your money just paying off your loan to begin with, because you're not risking that money being lost. It might be better just to pause your heavy contributions in the meantime and just focus on paying down your debts. While you can earn money in the stock market, it's not guaranteed, and you're inherently taking on risk by putting that money in the market, which could better serve you going directly down and paying your debts off. When you have these debt balances, you're constantly having to service and maintain them until they're gone. You're constantly serving the debts that you owe. This can ultimately force you into a decision that you might not be fully invested in, like a job that you're not interested in. If you're about to go to college, I encourage you to be as strategic as possible when choosing your degree path and your potential career outcomes because of that. At the end of the day, it's up to you to make something of yourself, regardless of your degree. You should aim to have your degree be a tool for your career and not a hindrance on your financial future. Personally, I went to a local community college and got my associate's degree after 2 years. After I transferred and graduated with my bachelor's degree, I can guarantee you that my employer didn't second guess me because I didn't attend all 4 years at a state school. No one cares at the end of the day where you went for the first 2 years. The next milestone I want to talk about is getting a job that you like. I want to iterate how important it is to be open-minded and willing to try new things, especially when it comes to career paths. Being open-minded and willing to try new things gives you the opportunity of finding things that you might actually enjoy one day. If you find something you like, you can stay in that field for a long time. It's often the case that the highest income earning potential comes from being a specialist in your field after a long period of time. If you can find something that you love to do and stick with it for an extended period of time with a conscious effort aimed at improvement, you're basically guaranteed to be rewarded for it. Just like investments, your career is a snowball. It gets bigger and better over time. Whether that's building relationships in your industry that will last you for decades to come, or building the skills required to be a specialist in your field over time. It's not the end of the world if you don't find your desired path right away. If you're open-minded and actively searching for these things, it will work out eventually. In the meantime, though, you still need a job. The next milestone that I want to talk about is more of a mindset shift, and that's avoiding lifestyle inflation at all costs. I've seen it myself. People that I know from college going and graduating, they're getting a new car, they're getting nicer apartments, they're getting nicer things all the time, new clothes. You see it all the time. You graduate from college, you get a job that pays you a lot of money, and then you start living a lifestyle that you assumed that your new salary would warrant. New furniture, new cars, going out to the bars all the time, new clothes, all these nice things. I want to be clear. There is nothing wrong with lifestyle inflation. But you can be a financial superhero for yourself if you are conscious of the rate at which you inflate your lifestyle and try to mitigate that rate as much as possible. I almost fell for it myself. Just to give you an example, when I first graduated college, I instantly started shopping for the brand new Supra. I wanted one so bad. I thought that it's what I could afford now because I was making way more money than I had ever made before. Thankfully, I didn't do that because if I did, I would have bought a $60,000 depreciating asset that I would have been paying $1,000 a month for or more to this day from 3 years ago, and then 3 years in the future. So I would have tied myself to this over $1,000 a month commitment for a car that really isn't going to do anything for myself in the future. now, not even 2 years later, and I can buy that car in cash if I wanted to, no questions asked. Point being, sacrificing the short-term instant gratification dopamine hits of lifestyle inflation will serve you in the long run. There's nothing wrong with having nice or flashy things, but at the end of the day, flashy and nice things don't matter, especially when you're in your 20s. You can eat ramen noodles and live on an air mattress and nobody cares. When you're in your 40s, avoiding these financial traps will make you a wizard with your finances in your early 20s. Now let's talk about credit cards. I have nothing wrong with credit cards. I use them myself. I'm very diligent and responsible with them, and that's where I have no problem with them. If you're diligent and responsible with them, there's nothing wrong with them. Being responsible with your credit cards can give you lower interest rates on the loans that really matter, which can save you thousands of dollars in the future. Just to put this in perspective, let's say you want to buy a house for $400,000. Let's say that rate is between 6% and 6.5%. Let's say you missed your credit card payment a couple times, and so the bank gives you 6.5% interest on that loan. That 0.5% interest will cost you $43,000 over the course of that loan in interest in the long run. So essentially, pay your credit cards off now so you can save $43,000 on 0.5% of interest on your home loan. Obviously, those numbers are just an example, but that's just to give you a perspective that 0.5% of interest on your most important loans can make the difference between tens of thousands of dollars in the future. So please, take your credit cards seriously. This next step is really fun. The next major step in leveling up your finances in your 20s is building a bulletproof budget and a savings plan. I found this to be the deadliest weapon in your artillery when it comes to personal finance. Something that I thought was worth mentioning is that people run away from things faster than they chase things. If you don't know what I mean by this, you've probably had friends or coworkers or family members that always talk about like the next big move that they're going to make and what's going to set them apart from everyone else, and then they almost never do it. It's just talk. Everyone wants to make the big next step towards progress, but you're more likely to chase that goal if you have something that you're running away from. That's what I'm talking about. Humans will naturally run away from catastrophe more than they will chase desires. So if you can alter your mindset to make your goals something that would alter your circumstances if you didn't achieve them, it's kind of a mental hack towards making faster progress towards your goals. Having a bulletproof budget allows you to know what's coming in and what's going out every single month. Having that bird's eye view perspective over your finances allows you to see the contributions that you could be making towards your savings goals. You'll even be able to see things that you might be willing to potentially sacrifice in order to achieve those goals faster. Go into your bank statements, see what spending is absolutely necessary, and see what could clearly be cut out or done at like a better cost efficiency altogether. This feels like gamifying your personal finances, and it gets really fun when you start to see the progress that you make towards your goals. After you have a budget and a savings buffer that can act as your emergency fund, you can now start what is personally my favorite goal, which is maxing out your retirement accounts. If you're in America, you want to be utilizing these two accounts because they're the best accounts that we have access to at our disposal. The Roth IRA and the 401k. The Roth IRA is your individual retirement account, whereas your 401k is your employer-sponsored account. The Roth IRA gives you the advantage of your earnings being completely tax-free when it comes time for withdrawal. This is like your golden nest egg where you can stack up all your valuable investments for your big payday in the future. This account is so good that the government actually limits how much money you can put in every year towards it. The current maximum in 2025 is $7,000 if you're under the age of 50, and $8,000 if you're over the age of 50 as a catch-up mechanism. You can open a Roth IRA account at pretty much any brokerage like Charles Schwab, Vanguard, Fidelity. I'm pretty sure even Robinhood offers the Roth IRA right now, so take advantage of those. You just need to have earned income, which basically means working for a job or earning your income through working. After you open this account, you simply just transfer money from your bank account into your Roth IRA, and from there you can begin to make investments with that money. I'll tell you more about what you should be investing in 1 second, but first let me cover the 401k. The 401k is a common retirement account. You're able to contribute a portion of your paycheck before it gets taxed into this account. The investment options in this account are typically more limited than that of a Roth IRA or an individual brokerage account, which means you're typically picking in different funds to put your money in rather than individual investments. What's magical about this account is that your employer will often match your contributions, which is a huge benefit. If your employer offers this, you should be taking advantage of this. The only drawback is that your money is tax deferred. So while it isn't taxed going in, when you're 59 and a half and withdrawing from that account, you will be taxed on your earnings. The contribution limit of this account is $23,500 in 2025. At the end of the day, it's free money for your future, so take advantage of this. Utilizing both of these accounts simultaneously, along with a budget and a savings goal, is going to put you years ahead of the general population. After you have these accounts set up, you need to know where to put your investments. I want to clarify that I'm not a financial advisor, and this isn't financial advice. I'm simply sharing my own experiences as well as what I've learned from those experiences and what I've learned from my own research. If you're not an experienced investor, your best bet is just going to be index funds, plain and simple. These are low-cost funds that you just put your money into that allow you to diversify into all of the best companies in the stock market. VOO, or VOO, is an index fund tracking the S&P 500. It's great for most starter investors. The S&P 500 is a conglomerate of the top 500 companies in the stock market, and it's weighted by market cap, which means that the biggest companies by market cap will influence the price action of the S&P 500 more than other companies will. QQQ is another index fund that I personally invest in. It's more tech-oriented, so check that one out as well. If you're not looking to watch over your shoulder 24/7 in your portfolio, index funds are a great start for most investors. These inherently will diversify you while also affording you the opportunity to have exposure to the best companies in the stock market. What I think is important to consider is your personal risk profile when it comes to investing. All these different investment vehicles have different projected returns on investment, so knowing what returns you're expecting to make will give you more clarity on where you should be putting that money to begin with. To make it simple, here are the common investments that the markets offer and the different levels of risk associated with them. I bring this up because I want you to try to understand how much risk are you actually willing to take on. First, they're government bonds. From what I know, bonds are basically the starting point. Bonds offer historically around a 2 to 3% return on your money after adjusting for inflation. Then there are mortgage-backed securities, which are like mortgages and home loans and stuff. You can buy index funds in mortgage-backed securities as well if that's something you're interested in, but they typically offer a lower rate of return than the S&P 500 would. They offer around 4 to 6%. After that is the S&P 500 and typical index funds, where you typically see a projected rate of return of around 7 to 8%. So there's a ladder being built. Government bonds, mortgage-backed securities, index funds, and then individual stocks. As you move up this ladder, you inherently are going to want to make more money because there's more risk being taken on with each of these investments. After bonds, then mortgage-backed securities, then the S&P 500, there are individual stocks. Individual stocks are inherently more risky than the S&P 500 because you're betting on an individual company, not the market as a whole. So you should be aiming to make more than 7 to 8% returns if you're investing in individual stocks because it's a higher risk profile investment. Just something to consider. If you're investing in individual stocks, you're inherently trying to outperform index funds. Because if you're not, then why are you not just invested in index funds to begin with? So understanding that ladder of inherent risk will give you a way more strategic approach when it comes to investing. I actually really like individual stocks, but the catch is you're essentially betting on horses. The one thing you have to your advantage though is genuine market research. If you can learn how to evaluate if a stock is overvalued or undervalued, you just wait for it to become undervalued in your eyes, and then you can make a confident buy in that stock and then expect consistent returns in the future. I made a video not too long ago talking about the lessons and strategies that I use to build my own $60,000+ stock portfolio. If you want to go check that out, it might serve you some value. I'll put a link up somewhere right here, but go check that out if you haven't. It might serve you some value. Just to give you some insight, my personal portfolio holds a lot of VOO and a lot of QQQ and a lot of individual stocks. I'm 23, so personally, I think I can afford the inherent risk that I'm taking on by investing in individual companies. I've also done my research, and I'm very confident in the buys that I've made. I personally see a great trajectory in these companies that I've invested in for the next 3 to 5 years, and I'm excited to see where that takes my portfolio in the future. The secret is investing consistently over time. Think about this. When was it ever a bad time to buy stocks 50 years ago? I'll wait. So yeah, just buy and hold and thank yourself 50 years in the future. These milestones are essentially setting up a roadmap. And if you can follow that roadmap with good diligence, it will set you up for immense financial success and freedom in the future. You don't need to be in your 20s to do this either. If you want to see a video where I break down how I personally evaluate companies and see if I want to invest in them or not, let me know in the comments below. And let me know where you guys are at in your own personal investing journey. Other than that, I hope you have a great day, and I'll catch you guys in the next one. See ya.